I'm going to give a brief summary after Charles, our securities lawyer, will give you an overview over securities and how they're being done so far. Hand for Charles.
Can everyone hear me? I am mic'd, so hopefully it's picking it up okay. My name is Charles Kaufman. I'm a securities lawyer at the law firm Lexcuity PC, formerly known as Homeyer Law. Some of you might have encountered Joy Law, our consultant and former partner, who's been a major thought leader in security tokens and founder of Verify Investor, which is the largest provider of investor verification services for crowdfunding. Forgive me also because I'm recovering from a cold, but if you have trouble hearing me, raise your hand and I will speak up. So, November of 2017 was kind of ground zero for what's come to be called security tokens, and what happened then is we had this emerging area of ICOs, initial coin offerings that have been going on for a couple of years, which came mostly from the technology world and cryptocurrency world, people who either weren't aware of securities laws or if they were trying to fly under the radar. And people were raising capital by pre-selling digital assets. And the idea was they were going to be what would be called utility tokens, cryptocurrency, other types of digital assets that would just be freely exchanged, decentralized repositories of value. But the problem from a regulatory point of view, when SEC, Securities Exchange Commission, put the brakes on it in November 2017, is people were selling something that didn't really exist yet. They were selling the promise that there was going to be this token that had this great ecosystem and great value that would develop, but they were taking money for investment. The people who were purchasing these rights to get future tokens were purchasing with an intent to make a profit based on the successful launch of the coins, relying on the efforts of a management team to make that successful launch. And all of those fit under something called the Howey test, which I thought was an obscure feature of law school securities classes, but a lot of ink has been spilled on the Howey test in the last year, that the ICO tokens fit into this, were securities, and under the securities laws, you have to either, if you're issuing securities, you have to either register that with the SEC, basically do like an IPO, or fit under one of several exemptions which are allowed for private capital raising, but which limit your activities so that you're not raising money from the public and from ordinary retail investors at large. So beginning in November of 2017, we started to see people saying, okay, so I may have a security, what do I do? How can I still raise capital using my digital asset? And that's evolved into the idea of the security token offering, where the issuer acknowledges that what they are offering is a security and wants to comply with the securities laws, or do their offering offshore to be completely outside the scope of the US securities laws. And fortunately, this came at a time where we were about 2 or 3 years after the Jobs Act rules came into effect, which greatly liberalized capital raising in the US and allowed for crowdfunding for capital. Now, everyone was, and I'm sure still is, familiar with crowdfunding like Kickstarter and Indiegogo, where someone needs an operation or wants to launch a restaurant or a brewery, and they go online to get people to voluntarily contribute small amounts of money without expecting really anything in return, maybe a hat or a seat at the table if it's a restaurant. But for the last few years, you've been able to raise capital through crowdfunding, actually issue stock to people under the securities laws. And it's principally been done, most of the capital raising is done under a liberalization of the old private placement rules under 506B of Regulation D. Now, I assume some people in the room have a longer history with startups before even the crypto era. Has anyone ever been with a company that did a private capital raise under 506B private placement? So in the old days, and 506B is still available if you wanted to raise capital this way, you you could not advertise. You could not do what's called a general solicitation to raise your capital. You had to confine your capital raising efforts to people you already had a pre-existing relationship, or go to a broker who had a pre-existing relationship. And one thing that's stayed the same in this type of capital raising is your investor has to be accredited. Your investor has to be a high net worth individual or a corporation that has more than 5 million in assets. The test for individuals is $1 million in net assets, not including your home, more than $200,000 a year in income, or $300,000 as a couple. You're limited to those investors. But what happened with the Jobs Act is it really flipped 180 degrees. You can advertise your company's efforts to go out and bring in investors and offer them stock, common stock, preferred stock, debt, any type of security. You can advertise it on the internet. You can go through an underwriter. You can put it on a broker's platform. You can put it in the newspaper. We've even heard these ads on the radio. As long as you make sure that the investors who actually purchase the securities are accredited. And that's the other difference between the old and the new capital raising. Before, in your traditional Reg D private placement, you could take the person's word for the fact that they were an accredited investor. Just have them fill out a questionnaire and leave it at that. But you couldn't even talk to anyone about the offering until they passed the vetting process and they represented reasonably to you that they were accredited. Now you can cast the net as wide as you want, advertise to anybody, accredited or not. But then the people you ultimately sell the securities to have to actually go through a verification process to make sure that they're accredited. And they're, for better or worse, the SEC didn't prescribe a single method. They've given us some illustrations. You can use any reasonable method, but typically it's going to be bank accounts, brokerage accounts, tax returns. Those are the best sources of evidence. And fortunately, there have been third-party providers which you can go to, and this is one of the methods that's been blessed by the SEC, is to have an accountant or attorney certify that someone is accredited. And it can be your investor's own accountant or CPA, but more and more, the website that's crowdfunding securities for sale will take you to a third-party website where relatively inexpensively, say I'm talking about less than $100 per investor, the information will be taken in automatically, and a staff CPA or attorney will provide a certificate that says the person is accredited. And then the investor doesn't have to worry about having given confidential financial information to the random issuer. They know it's going to be held in confidence. So since this first became available about 3 or 4 years ago, many billions of dollars have been raised through, it's called Title II crowdfunding, or Rule 506B. And that's been the biggest method that token issuers who have determined that what they're selling is a security and want to do it in accordance with the US securities laws, make their sale, have been using this Rule 506C. There are other forms of crowdfunding available which have distinct advantages or disadvantages. As I mentioned, 506B, you're limited to accredited investors. You can advertise to anybody, but you can only close with someone who meets that high net worth individual test, or as an entity that meets the net worth test. But the SEC also modified an old rule, which was seldom used, called Regulation A. And I think they were the first ones who started to call it the new version, Regulation A+, and that's what it tends to be called now. But this is conceived as kind of a mini IPO. It's a junior IPO. It's an offering that is reviewed by the SEC. Your offering document has to meet certain criteria and be reviewed by the SEC. Depending on how much you're offering, you may need to have audited financials, and it's reviewed. But in exchange for that additional regulatory effort, you can sell to non-accredited investors. You can sell to anybody, rank and file investors. You can raise up to $50 million under this offering. And to boot, the securities that you issue under Regulation A are freely tradable after they're sold. Now, freely tradable doesn't necessarily mean you're offering your investors real liquidity. And most of the issuers that have used Regulation A+ haven't gone an extra step to try to place the shares on some kind of market. But the Jobs Act, one of the things the Jobs Act was intended to address was the closing of the IPO window in the US. That we lost what we had through the 1990s of growing technology companies. When they reached a certain stage, they could give an exit to their investors through an IPO. You had IPOs in the $30 million, $50 million range, and they were graduating to the exchanges and becoming micro or small cap public companies. Those types of offerings seldom happen now. Most of the IPOs out there are the unicorns, you know, the Facebooks or the Snapchats, and most of the investment bankers are only interested in taking you public if you're going to have like $1 billion market cap post-offering. So the idea was Regulation A plus, you could raise up to $50 million and you could go to the OTC market. And the SEC has also been encouraging a level of exchanges called ATSs, alternate trading systems, where securities could trade, you could give some people liquidity in companies. And the thought behind this is that venture capital is waiting for an exit with many of these companies. They've backed successful companies, but they can't get their money out because the IPO window is closed and their companies are not being acquired, and that this would free up capital. It's not working that way yet, but more ATSs are coming online this year, more of these alternate trading systems. And the OTC bulletin board, are any of you familiar with it? Have you ever bought stock on the OTC bulletin board, or had the misfortune of your company's stock falling down to the OTC bulletin board? It used to be kind of the graveyard of companies. If you were on NASDAQ but your stock fell off of NASDAQ, you ended up on the bulletin board. But last year, for the first time that anything like this happened, 70 companies graduated from the OTC bulletin board to the New York Stock Exchange and to NASDAQ. And the FINRA, which runs the broker, the semi-governmental body that governs brokerages in the US, is really trying to position OTC as that junior market where a company can have trading wheels and be traded in a modest way and then move up to the major exchanges. So that may emerge as a path to liquidity. And then the other crowdfunding avenue that lets you go to non-accredited investors is called Regulation CF. And this was the one that Congress pushed the most when they did the Jobs Act. They had the most hope about this because they thought this would be the Indiegogo idea, but brought to financing. A lot of small investors putting a little bit of money into a company and getting it started. But the SEC had the most reservations about this because they were being rather paternalistic about the small unaccredited investors losing their savings by investing in these companies. So it took forever for these regulations to get issued. They've only been out for a year or two. And you're limited to only raising $1 million under CF. There's a cost of living escalator, so it's now up to like $1,070,000. But that's not really enough to launch a business. It requires you to submit your documents to the SEC, but you don't have to go through a review process like you do with Regulation A. And so it's a fairly easy, inexpensive process. You get that path to ordinary investors. There is a limit. Again, this sort of paternalistic limit that someone can't, a non-accredited investor, non-wealthy individual, can only invest so much of their income in a Reg C offering. But despite the handicaps, and despite the fact, I think in total Regulation CF has raised maybe $300 million since it's been in existence, which is not a huge amount of money. But it does have a certain niche. The biggest user of Regulation CF has actually been microbreweries, and similar businesses have been having success with it. If you can get somewhere with just $1 million, it's actually a good avenue for fundraising if you have a strong social network following, or if you have a customer base that might want to put a little money into the company and participate in the company's growth. It's a little bit restrictive in the way it can be advertised, but people are having success with Regulation CF. And as crowdfunding has matured a little bit over the last couple of years, a lot of the offering activity has coalesced into a few internet offering platforms or companies that operate them. The best known ones would be Start Engine, Seed Invest, and Republic. And you know, basically they do an underwriting process if a company comes to them to make sure that they think it'll be a successful offering, and you pay a fee. They're registered as broker dealers. They can close the offering for you, put it out on the internet, and they have all of these sites have potential investors who come to them that could be introduced to your company that way. Some emphasize Reg A Plus more, some emphasize CF more, some 506C, the Title II crowdfunding. So I know I've covered a lot of ground there, and we've gone a little bit far from the token world, but those are the means of financing that have been used when token issuers have moved to the idea of having a security and issuing it in accordance with the securities laws. So one thing that I wanted to mention is, and I think some in my profession have done a disservice by telling people when the SEC first came down on ICOs, look, you're selling securities, just admit they're securities, do them under an exemption, or register them, or use Regulation A+. And yes, that makes the offering lawful. The problem is, for many of the reasons that people think that coins, tokens, cryptocurrency will be valuable, you will limit yourself if you issue it as a security, because there are restrictions, because in many cases you have to register as a public company, and that whole regulatory scheme is not really suitable for a true coin or a true token, something that you want to be out there in the marketplace, anybody to be able to buy and sell it, fractionalizable, decentralized. Why is a regulatory system that emphasizes disclosure of management relevant to that type of instrument? It's not. So the quandary, though, is if you're trying to raise money from that type of coin, which is eventually going to be decentralized, not a security, but if you're trying to raise capital off of it, the capital raising transaction is a securities transaction. The focus is on the nature of the transaction, not the nature of what it is that you're selling. So what we're seeing more and more is people who want to raise capital off of a digital asset, but then have a true blockchain digital asset that functions as a coin or a cryptocurrency, splitting the two features. It's sometimes called a two-token structure. What you offer in your securities offering that you admit as a security and will always be a security is something closer to a conventional stock or bond. It's a right to get a share of the revenue that the utility token will generate, or it's a right to the company's profit, or maybe it's even just an equity interest in the company that's going to have this great digital asset business down the road. And then you bifurcate the two. You later do a coin drop or an airdrop. You put your true coin out into commerce so it can function as it has to, and that's never going to have to be registered as a security, treated as a security, limited to accredited investors. But you just make sure that token is sold just for use in the network, not for capital raising. And you limit your capital raising to something that you're comfortable treating as a security when you issue it, and you'll be okay if it's a security a year from now or 2 years from now. That won't crimp your style. If what you wanted to be a freely tradable in the marketplace token gets tagged with the notion of being a security. So that's been kind of a random walk, I guess. Does anyone have any questions about what I've done so far? Okay. Okay.
Do it after.
Great.